Welcome, welcome. Well, that was an awesome little video showcasing who and what the Real Estate Wealth Lab is. It is wonderful to see so many familiar faces. Oh, wow, this is really cool. And some new faces. Harry, welcome. This is your first call. Danny, I'd love to see you. And Michelle, awesome that you can join us today as well. Of course, Dawn Ronson, Deanna, you made it. That's fantastic. This is awesome. And Jay and Heidi. Oh my gosh, Anita, this is so great. So we're just going to get started here. Thank you all. Pop it in the chat where you're joining us from. I know it's all over Canada and some in the US. I guess, Deanna, you're back from Mexico, Curacao. I think that was Mexico. Edmonton, Vincent, right on. Palm Springs, you're in Palm Springs. Got it, Deanna. That's awesome. Latif, you're from Kelowna. That's so cool. Love it there. Invest there. Awesome. Well, welcome. Oh, the waterfront in Abbotsford. I know that's our hearts go out to all of those impacted by the flooding in British Columbia, and particularly, of course, those in Abbotsford. Yeah, that's a very challenging circumstance. And I know I've got tenants there and I've been checking in with them as well. But they seem to be all right. So that's good news, and I hope everyone else is as well. Toronto, right on, and Kawartha Lakes, right on. Okay, well, thank you so much for playing with us. We've got a lot to cover today, so I am going to just get started. I'll share my screen, and one moment, please. There we are. Okay, all right. Well, you're at the Real Estate Wealth Lab Research Lab, and I am Jennifer Hunt, and I am the Chief Intelligence Officer with the Real Estate Wealth Lab. And I'm going to be guiding you through a next little while together, so hang on. We do have a disclaimer, and this is just a disclaimer for any forward information. You've got to get all of your legal stuff in handled. There you go. And we do have some chat rules. Oh, hey, Patrick from Victoria. That's Dad. Hi, Dad. Great to see you. So in the chat rules, we do say, please ask questions, please put in feedback, say hello, engage with one another, engage with us. If you've got questions as we're going through stuff, pop them in there, or ideas as we develop what is next for our next level investors. And of course, it goes without saying, please be respectful, be courteous, be kind. Those manners are important. However, we do ask that you do not solicit and you do not sell. These aren't the times for that. We will have opportunities as we have a property shop, and we've got lots of opportunities for engagement in other areas of the Real Estate Wealth Lab. So you'll have plenty of opportunities, but not in the chats. So thank you very much. The little housekeeping is that this is being recorded. As a registered guest, this will be made available to you. And for the Real Estate Wealth Lab members, awesome, it is in your member portal. So these you can come back to, and we are actually doing some really cool stuff back there, which you will get a little bit of a snippet tonight. So here's our agenda tonight, a lot to cover. Who here wants to learn about investing in US real estate? Pop it in the chat. Is that something? Yeah, right. So raise your hands. That's awesome. Pop it in the chat if you want to learn about investing in that. Yes, Beverly. Awesome. Cool. Well, this is 100% Lois. Awesome. Tammy. Oh, Hugh, right on. Yes, that is your next move, Hugh. We were talking about that. So that's super cool. And multi and mixed use. Definitely, we've got that covered. Now, obviously, it's a very large topic, so we're not going to cover all of it, but we're going to get you started, and we are going to be diving into that tonight as our first time. And as you know, the Real Estate Wealth Lab is North America, so we're going to be providing you next level real estate intelligence to go over Canada and the US at the macroeconomic level, and then we're going to talk a little bit about investing in US real estate, and then our very first ever market analysis at the state and city level for Honolulu, Waikiki, and Maui. Now, you might be going, okay, well, that's not the market for me yet. No worries. We're going to be doing lots of market analysis at REWL next year. So hang out with us in 2022 and beyond. We're going to just start with the most West Coast palm trees, and then we're going to be coming over to some East Coast palm trees. And so Florida will definitely be up next, and many others that you have asked for, the Carolinas, the Arizona, you name it. We've got some Texas going on, and many, of course, as our Canadian markets as well. So that's our timeline. I am going to be blasting through a lot today. Welcome, members. Thank you so much for being a part of the Real Estate Wealth Lab. Thank you so much for joining this community. And we are still doing a free trial, and we're looking forward to you sticking around with us for 2022 and beyond. And you might want to know why. All right, because we've got an incredible team. So we've got, I'm just going to have everyone wave. We've got, well, me, I'm here. And then Naran, where are you? Just give a little wave. He's our Chief Leadership Officer. And we've got Vincent, our Chief Technology Officer. Hi, Vincent. And we've got Yan. I'm not sure, I can't see you, but Yan, he's our Chief Marketing Officer. Paige, our Head of Customer Experience. Right on. And Ken, our Chief Operating Officer. Woohoo! Right on. So pretty cool team that's all rallied together for you for next level investing. So we are experiencing right now our open house. It's a free trial. The Real Estate Wealth Lab is new. And so we wanted to have you have an opportunity to check us out as we're showcasing who we are and what we contribute to you. So this is September, October, November, December, and December 31st is the final day of the free trial. So there's only, you know what? I did this the other day. I think it was 37 days. Yeah, no, I think it's 37 days left today. But regardless, it's December 31st and the clock is ticking. So we want you to check out our free trial. And I'm going to share with you, and Ken is going to come on and share with you a little bit more about what that looks like and what you can experience in your trial. So we've got terms of events, November. Wow, like where did November go? So today is it for November, and our next two events are in December. So we're almost out of those free events. So you're definitely going to want to check them out. What you get when you get our free trial, you are automatically registered to the rest of our events. You receive a weekly real estate intelligence newsletter. Now that list is growing. I know the number of you who got that email today. It's sent out weekly. Pop it in the chat, please, if you are a recipient of the weekly real estate intelligence newsletter. Did you get yours today? If not, go and check it out in your inbox, or in your might be in your spam, because I know that some folks it's going into your junk folder. So you'll definitely want, oh, Michelle, you got it right on. Very cool. Glad there's some real fun stuff in there this time about turkeys. Yes, turkeys and real estate. So if you haven't checked that out, you'll want to. And then of course you get access to our member portal and our service team. And this is a little bit about what the newsletter might look like. It's giving you a summary and then what it means, so that you don't have to look at the crazy headlines out there and try and understand all of the policies and politics and you name it that's going on. So some of the products that we offer our members are a ton of them. And we're not going to go through all of them, but I wanted to give you an idea of what that looks like. The Deal Dicer, Airbnb. Who has actually considered doing an Airbnb? Yeah, I do a lot of them, and I love this calculator to help determine. It's absolutely incredible. All of these are available to our Real Estate Wealth Lab members. And as you can see, there's a lot of them, and they build on each other as well. Here are the next two dates that you're going to want to put in your calendars. The Community Lab on third Wednesday of the month. That's coming up on December 15th. We are skipping the Market Leaders Lab on December 8th this month. And then the Research Lab, December 22nd, just right into Christmas. We're not taking any breaks, but you'll be able to check that out on December 22nd. And Ken, let's bring you in to demonstrate our member portal, some of our products, tools, and assessments. And just a little sort of notice here, everyone. We're not going to do this at every single Real Estate Wealth Lab, obviously our research labs, but we want to make sure that you know who we are and what we've got. And Ken is the perfect person to take us through that. So I'll stop sharing my screen, Ken, and let you drive.
Absolutely, absolutely. Thank you very much. Can you guys hear me okay? Everybody's good? Yes, thumbs up. Awesome, good. Thank you for having me, guys. I appreciate your time. And listen, I'm excited for the US stuff, so I can't wait to get into it. So I'm going to breeze through some stuff. If you have questions, please reach out, info@realestatewealthlab.com, and let's get started. All right, so let me share the screen here. Everybody see the Take Your Real Estate to take your real estate before the next level screen. Yes.
Looks good.
Excellent. So that's our homepage, guys. Pretty straightforward, right? Everything's up here at the top. Jump into our mini lab. This is totally free. Send your friends here. Play with our calculators. We've got a lot here that are live. You can do these for free. Again, there's 3 or 4. Actually, I think there's 7 or 8 now, to be quite honest with you. The cash flow calculator is a good one. For those of you that haven't dived in, I highly suggest you jump in and
Hey,
take action on that.
Ken,
Yeah.
is that a DISC personality test that we're offering for free?
We are indeed.
That is incredible. That's actually that's an amazing test. Okay. And what would be the benefits of that so that we understand how we can be next level real estate investors?
Listen, I think that the best challenge in this world is to know yourself so that you can better align what it is you want to do and where you're going. And knowing your personality traits helps you acquire the things that you need most. So you understand what it is you're looking for. So I think it's a phenomenal test that you can do for yourself, and it's totally free. Jump into the mini lab.
Cool. That's amazing.
Yeah.
So you can build your power
Absolutely.
team around your strengths and weaknesses.
100%. 100%. All right. So as I log in here, I'm clicking on the login button. It'll take me to the dashboard. And this is where you'll find everything. So this is like your home hub. Okay. This is where you want to go. In the corner here, this is the navigation tab. Again, the laboratory takes you to like a store. Our mini lab is the free mini lab I just showed you. New announcements, product releases, upcoming events you can get here. Your settings, update your profile picture, just like mine. And yeah, so guys, I'm going to dive in real quick. City-specific market analysis. You click on that. That's literally going to take you right inside. And what Jennifer's doing is all her events, sometimes she combines 2 or 3 together, but you don't have time to watch them all. So what we're doing is we're chopping them specifically by market. And then we'll take that segment and plug it in. So if you're just looking for Calgary, if you're just looking for Toronto or Vancouver or Kelowna, you can do that here. So it's all broken down, right? You can see it all there by date.
Woo!
Okay, so you can jump in there.
That's already quite a few market updates, isn't it? We've only been going for September. Right on. That's cool.
That's what we're trying to do. Absolutely. The next level of real estate intelligence. If you didn't catch your email, guys, jump in here and grab it here when you go inside. They're literally right all here for download. So in case you couldn't see the email, it went to junk, not to worry. You've got one location where you can go and find it. This is essentially what it looks like, the finished product. And again, what it means and the summary saves me time. Again, one of my favorite things that REWL has to offer. So kudos to you, Jen. Again, I can't say enough about this. Saves me a ton of time and provides value to my clients as a realtor. So
awesome. You know what, Ken? Well, thank you. And I'm glad that you find it valuable and that next level investors are finding it value. I appreciate your feedback. I love it when people get in there, like Lewis the other day. He's like, so you recommended some restaurants at some of these places that are top cities. I'm like, yes, I did. So I'm reading it through all the way through. But I think it's really, really what you said there, Ken, is so valuable that you can use this for your clients. And so real estate investors, please go in, use this and showcase how smart you are, and you can help your clients just really quickly. Oh, awesome. Thanks, Lewis. Right on.
Absolutely. Good. Okay. So just as we continue on, the live digital event library, if you miss an event, again, everything's here in the portal. When you click on it, the entire lab is in here. Any live event that we do is in here, the full event. So if you want to watch it, nothing better to do, sit back, grab a coffee. If you don't drink coffee, get a water, a tea, something, and dive in.
Awesome. And Ken, we've heard from a number of REWL members of some suggestions, and we are actually in the process of implementing them. So thank you for your suggestions. Really appreciate it. So we're going to be making these so that you don't have to watch the whole thing, because there's definite segments, inflation, housing affordability, U.S. real estate, so that you'll be able to actually tag them, be able to see them really quickly. And only if a particular section only interests you, then you can go straight to that section. And we're even, Ken, correct me if I'm wrong, even considering transcribing them. For those of you who prefer to read or search, you'll have that information as well. So thank you for your feedback.
Yeah, Jen, you're letting the cat out of the bag too early, Yeah, okay, so she let it out there. That's so I can't deny it now. But yeah, more to come, So guys, stay tuned for sure. All right, as we move along, Jen's presentation decks, they're all in here as well. Pretty straightforward stuff. When you go inside, guys, use the decks. You have them, show your clients statistics. This is how you take your portfolio to the next level. Everything that REWL is about is doing just that. So I use them. I'm showing how smart I am by showcasing the documents. This is why you want to buy. This is why you want to sell, that sort of thing. So use them to your advantage. You have them. So
something about that just that I want to highlight as well is what we're doing differently that no one else is doing. And when we're doing market analysis, and even when we're doing the macroeconomics, is actually providing you with screenshots of data with the sources. So as a result of that, then you can go and use that data, even if you're blowing through it really, really quickly or whatever have you, you can go back and go, you know what, I need that GDP slide, or, you know what, I need the market stats for Maui in terms of sales. You're going to get that today. So you have it at your fingertips, and you'll also know how to find it in the future if you need it updated.
Absolutely. I love this stuff. We're making it so simple and easy. It's, no comment anymore. Let's see here, where am I at? Okay, REWL Investor the Profile and Assessment. So this is a tool that we'd like to get to know you better. So these are profile questionnaires and assessment questionnaires. Give us a little bit about your experience, how we can provide you your data. Like, do you like to read data? Do you like to watch data? Do you like to listen to data? So this helps us get you the information at a rate that you need it. So it helps you take your portfolio to the next level. So these are for you. These are for us to get to know you so that we can serve you better. The portfolio diagnosis for members right now, what we're offering is a free portfolio diagnosis. What this includes is a small questionnaire, but the thing that starts this off on a kicker is the calculator that starts the whole thing. So I'm going to show you a live review of the calculator. So we'll go right in. Give me a second. And this calculator will spit out, because it has live data for you, but it'll actually go through everything for you. So as we type this in, go ahead and trial it. Guys, jump in the trial and you can start doing it. It does all of these features for you. So I'm going to skip ahead and show you, this is, when it's completed, some of the numbers it'll give you. And again, as you move the sliders or type in the details, your numbers will change. So we can go ahead and do all that stuff. And then what's great about this is I get to use this for my clients, is it spits out a nice little report. Okay, so the report is key, makes it look nice, gives us some good numbers, stats, and it definitely helps us through.
So there's a couple of reasons that I freaking love this. Is first of all, I created a spreadsheet that is just ginormous and mammoth and kind of a pain in the butt to enter, and this is way better than that. So kudos to you and your team, Ken, in operations, for doing that. It's huge. And then also, if you could scroll down a little bit, I think that's really important, number 13 and 14. So when we consider where we are today, or again, as Ken mentioned, where your clients are, this is being next level. So being able to showcase, hey, clients, this is where you are today. This is where you're saying you want to be in the future. Now, how do we reverse engineer your plan so that you can get to your financial future, your certainty, your retirement plan with the number of units by real estate? So you can see here that the gap is just, what you need is 147 units. Yes, and that's what we can help you with. So this is, of course, just an example, but that's huge, huge.
Yeah, no, listen, this is the starting point, right? You sit down with someone, this is your entire portfolio at a glance and where you want to go, then identify some gaps for you. Now you can sit down with someone and start prepare what the action steps are. So get in there, got trial members, get in if you're new, go ahead and try it out, because I think you'll like it. You'll be pleasantly pleased.
And I'm seeing, Oleg, you're asking, and Paige, thank you so much for popping that in the chat, is yes, you as a member, in our free trial, you have access to all of these right now. So go in and play with these, see what they deliver for you. And that's like all of it. And this is actually, we're actually showcasing everything, aren't we, Ken?
Oh, yeah, it's all in there. It's all in there. Not what I'm not releasing, what I'm still building. There's still some other stuff that I'm going to hold on the side for real advanced analysis. So that's all I'm going to say about that.
Nice.
So quick calculators. I mean, whenever we're in a rush, we always need a quick calculation. Again, these are all mobile friendly, tablet friendly, desktop. You can do these live. We have the fast filter. If you want to see if the property will cash flow quickly, you'll want to use that. If you want to know what to offer on a place, you want to run some quick numbers, do that. If you want to split a deal with someone real quick because they hey, I'd love to do the deal. Hey, let's see what it's worth, or let's see what we can put together. Can you afford something right now? What will your place sell for? What will it cost to actually build something, a brand, foundational? Property management versus non-property management. You want to buy some time back, this is a good quick calculator to figure out that for you.
That buyback time is wild. When you actually do that, you will start outsourcing a whole lot more than you ever thought you would before. Tons. Sorry, go ahead, Ken.
No, absolutely. What else we got here? What else did I do for you guys? Let's see, the Airbnb. Let's just run a quick, how are we doing for time? We're okay for time?
Yep, we're good.
All right. So here's an example here. Now we jump into the Airbnb calculator. I'm in North America. How much advance notice? I probably need a couple days to clean it, and then you can just use the slider. I want to Airbnb it as much as possible. And then
get that churning.
Right? That's right. Let's say, what does it cost me to hold it? Let's say it's $3,000, and I have a great view, and I'm in a famous city. And that's what I could be renting my unit out for per month.
Right on.
Quick numbers, folks. Get in there, play with these things. Let's see what else we got here. The pathway to profitable portfolios. This is here is the big calculators. These ones have some serious numbers attached to them. We've got your budget, the portfolio diagnostic, which I've showed you. Renovation of profit. You want to see if a property has profit that you want to renovate it or flip it. You're going to want to use the profit revitalizer. Deal analyzer, straightforward. Is this deal going to make you some money? Yes or no. This is the deal fractionalizer. What are you actually splitting on a deal with someone? Figuring out those details. What are the splits? How much you're putting in? What are those splits worth? And then the portfolio prognosis.
I want to just touch on that deal fractionalizer. So the deal dicer is kind of just like a quick one, like, oh, okay,
Yep.
you're bringing this to the table, you're bringing that kind of like 50-50, 70-30. And this is where people, not next level investors, but a lot of individuals get tripped up pretty quickly on these, is that it is not necessarily a 50-50 split. So ever. So, oh my gosh, I love this. Oh, walk us through quick deal dicer.
Show you quickly. I'll just show you a quick difference of it, right? Like if you want to own the property, fantastic. Are you able to purchase on your own? Then they calculate, say, like, do you actually need a partner? Like, you know what I mean?
Right.
So, and then you can redo it again if you really wanted to play around with these things. So dive in. Do you bring more? No, let's just say no. I'm not going to find the deals. Do I have experience? No. Will you provide? Yes. Am I qualifying? Yes. And then it'll give me the number. Now, what I'll show you the difference is between this one and the deal fractionalizer is that these are a little more sophisticated, where we're going to dive into the numbers. Again, bear with me. Let me just dive in here. It's going to ask me for my name again. 1 second.
Yeah, I love these. I mean, Jay, indeed, this is very powerful. This has saved people so much money and equity that people often just leave on the table. And by the way, I literally use these documents. I will print them, I do them up, I print them. There we are, Jen. All right, print them out, and I show them to my potential partners. And it makes it just takes the emotion out of it. It's like, yo, this is what it is. You're bringing this, I'm bringing that. This is how we're gonna dice it and fractionalize it.
Yeah, and let me just put these in quickly.
Oh, and Ken, as you're putting these in, so I just want to highlight to everybody, see how it says like 10%, 20%, 50%? That's not necessarily, oh, you're bringing 50% of the down payment. That's the weight that it is. So you could be bringing 100% of the down payment, but that has a weighted in the calculation 50% weight for it to calculate your percentage of ownership. Hope that's clear.
Yep, and take your time when you're doing these calculators. I'm doing just some fast numbers, just to say how much, just to show you guys how it all actually works. And then I'll, and I think we're actually going to do one of these live, Jen, show an actual live deal and go through the whole thing. So we'll do a working session on that.
Yeah, at our next community lab, because we've heard a lot of you REWL members during your free trial, you haven't had the time to just get in there. And so we're actually hosting at our next community lab on December 15th, a time for you to get in and play with these calculators. And we're going to have lots of breakout rooms. You'll be able to move around, check them out, meet people, and actually dice and slice your own deals right on the spot with help.
Absolutely. So that's my thing. I want to make sure everybody gets in there. Paige, if you can put the link in the chat, but get in, try them out, play around with them. You've got to the end of December to use them, full access. So knock yourself out, folks.
Well, and that is huge. So Ken, thank you to you and your team. Major kudos putting all of those together. We've only been around since the end of September and we're just getting started. So we've got a lot in store for 2022. And thank you again, Ken. Huge kudos. Awesome. Okay. So are we ready to get into it then here? I guess I am going to share my screen. And I hope that this will work. Do you see my PowerPoint right on the demonstration? Awesome. Okay, great. Perfect. Thank you. All right. So as we mentioned, that we're going to do for our next community lab, we've already done an orientation. You've got an orientation to all that's available to you. And now we're going to set it up and really support you on a guided exploration, if you will, and application of all of these calculators and so much more of what REWL is. So watch your email. That will be December 15th for you to register. And if you haven't already, start checking out our Real Estate Wealth Lab. Our team, Yan, our Chief Marketing Officer, and his team is just doing an incredible job. And there's some fun videos on there. We're professional, we're economists, we got that. We're next level real estate investors in the trenches, but we're having some fun on social media. And there's some really cute videos that will actually unpack some of these complex conversations and complex ideas in even a more simple form. So that you can also connect with us at info@realestatewealthlab.com. So we always love to hear from you. And in fact, thank you to Rick D. He's a member and he contacted us today. And we are going to be addressing your question live. So I hope, Rick, you're on here. Pop it in the chat if you are. It would be great to see you. And we'll go through that. Okay, so now we're going to get into our research lab. We're going to be talking about the macro and micro, mostly the macroeconomics affecting real estate. Oh, Rick, awesome, cool. Okay, I got you. I got your question. We're going to handle it because you're right. So the business, essentially our real estate cycle formula is essentially the business cycle of real estate. So we're always kind of curious to know the duration of a phase, a period in the real estate cycle. Yeah, is it contracting? Is it stabilizing? Is it expanding? And that's really all it is. And we have our real estate cycle formula, which is very different. We want to look out as far as possible. Yes, and right now we're looking out 10 years down the way. But what we've done, and no, you can't see all of the other indicators that are in here, but we've got these key leading indicators: GDP, the economic health, jobs, a whole slew of components under jobs, and people. Now, what we do is we look at this very differently. You'll see how these go up and down. That's because they're constantly changing and they've got different weighted impacts at different times. So we look at population very differently, jobs very differently. And you're going to see this today as we're starting to, and this is always happening. We're always looking at it because it's constantly being refined and constantly shifting. And I will give you, in some of these leading indicators, I will give you a little tip that nobody else has included in anywhere, is the impact of inflation. Full stop. It's never been calculated in a real estate cycle before. It is our real estate cycle formula, includes inflation, and that is very material right now. And then we look at lagging indicators that could be impacted 2 years, 3 years, 7 years, 10 years, sometimes as short as 6 months. We've seen that in Vancouver. They had a short cycle. It was 6 months, but we're able to see it and actually predict the duration. So we've got some questions about that, and I will address them a little bit later. All right, so we're going to look at Canada and the US markets in terms of we always start with our economic health. So what's going on in terms of our economic health in the US is essentially it's growing. This is good, but it's not growing as fast as they expected, and by a significant margin here, because Q3 saw the Delta variant of the COVID-19 shutdowns, and that had a larger impact than expected. So it's actually been the slowest growth that we've seen. So that's pretty significant, but we're still seeing that the growth is being driven by, some spending and private investment. The local government spending is still having an impact on the economy, those stimulus checks, and we're seeing that in the jobs market as well. So as you can see in this graph, that we've got a 2% growth in Q3 2021 from 6.7% in Q2. So not where we want it to be. Definitely, it's implying that this is an even slower economic recovery. And again, because we're looking at that weighted impact on the economy, this just means that it's going to be a long stabilization, a long protracted expansion period. And so what this actually shows you is that it is a buy signal. It is a buy signal for those who are seeking opportunities in long-term buy and hold and investment tactics, because we are going to be on a slow recovery for a very long period of time. There are going to be some fluctuations, and I forecast those to be in 2023 and 2024, and I'll tell you more about those. But if it's a long term, now's the time, folks. And all right, so CIBC for Canada is this take this job and shove it moment. I love their reports. They're so fun. But yes, we are seeing that there's a big impact in jobs. Wages are a hot topic right now because they are not rising at the same rate as inflation. And individuals in both US and Canada you may have heard this term, the Great Resignation. I'll talk about that when we get to the jobs section, but it is impacting our GDP, our economic health. And I'll just jump ahead really quickly here. These are showing that we're not as productive. We're not recovering as quickly as previously forecasted by the economists, although we've been talking about it being a really slow recovery here at Real Estate Wealth Lab. And they're talking a lot about the labor shortages, both in US and Canada, as being kind of the main impact, as well as global supply chain issues, for sure, that are impacting GDP. I'm going to talk a lot about this labor shortage issue because something smells a little funny about it, but we'll talk about it in just a moment. This is a really great graph. I'm sorry, it seems like it might be a little fuzzy, but I love this because that means that our team didn't have to. But you'll see at the bottom that these are, so it's got Canada, Bank of Canada, Bank of Montreal, CIBC, OECD, Conference Board of Canada data, Nova Scotia, and Royal Bank. What we do at the Real Estate Wealth Lab is we always want to make sure that we've got tons of different sources, because even something like a GDP prediction forecast, I should say, we see that they are different, and which organization tends to be a little bit more optimistic versus pessimistic. And when we start to see them all together, you really need to get that average of what we're expecting. So the red is our 2021 expected GDP. Now remember that these are GDP growth. So we always want to be netting these out. And in the most cases, our economic health, we're not quite there yet in terms of really coming back with a good, strong economic recovery. You'll see that though, that's as good. So there's still growth in 2022 and growth in 2023. And so these are compounding and will be growing out of this, the pandemic induced situation. But this is a fantastic chart because you can kind of get a sense of where we're actually going to be, for next year, for example. Is it 4.5 or is it 4.4? 4.0 for CIBC, Bank of Nova Scotia 3.8. So we'll probably be somewhere in there. And that's, again, just looking at lots of different sources, and now you have them available to you too. So when we plot this on our real estate cycle formula, but the US is the blue arrow, the red is the GDP for Canada. And yeah, very scientific on this, I can tell you, but you can see that it's just up. It's not, actually, I wanted to put those arrows just a little bit down, but I couldn't, because then it would just be flat. So it's just slightly upwards. And you're going to start to see how these fluctuations or reverberations that draw out that real estate cycle. Jumping into jobs. Yeah, who here has heard of the Great Resignation? Anybody? Pop it in the chat. Have you heard that term yet? Yeah, okay, I saw you, Hugh, and smiling Tara. Awesome. Okay, cool. So 100%, yeah. So the Great Resignation, and we've heard of the Great American Migration and the Great Canadian Migration. Ward, awesome. Thanks, Kirsten. Yeah, so the Great Resignation is happening, but I have really cool news for you that you have to, okay, I just read it today, so it didn't make it into the presentation. It will be in next week's weekly newsletter, so please get into the trial because you're gonna want to hear what's next. So check that out. I'll have the whole article, but what we've seen is Americans are quitting their jobs. So 4.3 million Americans quit their jobs in August. 4.4 million more quit their jobs in September. That's massive, massive resignations. Canadians are experiencing, okay. So I'm going to dig into this. Don't worry. So Canadian wage inflation looms as perfect storm hits labor market. Same thing. Canadians are they're in a seller's market for their skills. There's a labor shortage, and wages aren't there. So in order to induce individuals to come and work for them, the wages are going up, which is a good thing, by the way. Thank you, Kirsten. I like your question of how many were parents who had to look after homeschooling kids. Very good. Well, I love that question, and we're diving into this quite a bit deeper in probably 2 more slides, because this is an interesting slide of the ratio of unemployed persons per job opening is lower than it was pre-pandemic, suggesting a tighter labor market. So you can see here in terms of Canada is red, the US is gray. In 2019, that was the number of unemployed persons per job opening. So there was just more available. But now we've got this labor shortage. You can see it's tightening the ratio. So this data supports that notion of the shove it. People are resigning, but workers are still participating and looking for other opportunities. So you may want to consider, what if you're trying to entice people to work for you, like what do you need to do in terms of culture and enticing them and wages and all of that and benefits and whatnot. But we are seeing that this immigration fueled population growth is impacting us. We have had no immigration basically for 2 years, and that is definitely contributing to the labor shortage because both the US and Canada rely on that for their workers. And of course, see how this is different? See how this isn't about GDP driving shit. It's not. It's actually about people driving jobs, driving GDP. There's the economic activity, it's not generating that way. We have to look at it differently and in reverse order. And that's exactly what we're doing because it is a reverberation. So these quit rates are that they're called. This is a really interesting article. I really liked it. And the quit rates basically measured by the Bureau of Labor Stats is an all-time high since they were first recorded in the year 2000. So in 21 years is like the highest number of people quitting their jobs and month over month. Okay, so why? Reasons are a combination. So exactly, I should have added that. Haha, Tammy, vaccine mandate, job loss, and economy crumbling. Yes. All right. Here we've got it. Homeschooling, you name it. Government pandemic handouts, of course, the stimulus. Why else are they potentially quitting? A changing demographic workforce from older to younger. People are retiring. Burnout and lack of work-life balance. A large cohort of staff with childcare issues. Nailed it. Some are still afraid of catching COVID at work. And this is not in there, that's why it's in brackets, but 100%, don't forget about the forced resignations for those who are opting out of the controversially mandated COVID-19 vaccines. Regardless of your view on COVID-19 vaccinations or not, it has, you've all seen it in the news in terms of healthcare workers, airline folks actually being forced to resign from their positions. And I know many of you on here even have had experience with that. And my heart goes out to you. This is, it's unbelievable. So that is, you know, when you hear labor shortages, also think that they're government induced labor shortages as well. It's not all that it seems. So other reasons that we're seeing is not seeing opportunities for development. These are inside of that as well. So the employees themselves, they're not feeling connected to the company's purpose, not having strong relationships at work. Sure, but honestly, the inflation is up. We're firing nurses, firing healthcare workers. Vaccinations are not even mentioned in any of this. And it's just, you know, sometimes news is more about what's not said than what is. This is very, very important. So I popped in here, there's this thing called Jobless Jobs and Non-Discriminatory Employment Service. There are individuals who want to be working. So let's just be mindful of this labor shortage crisis. But another solution that's offered is hiring really remote. This is literally what was suggested in this article by CEO World. And you know, it's interesting. Like vaccinations are not mentioned at all as a contributing factor, despite what we've seen in lots of people and knowing lots of people who have lost their jobs over it. But they're suggesting hiring really remote. So what does that mean? That means overseas in different time zones, which can have a huge benefit, by the way. It's awesome. I've worked with international teams for years and I love it. And it definitely raises productivity in different time zones. I'll be heading to bed and the team will pick up and then you just keep on going. It's fantastic. And it can reduce costs and it will help fill the employee gap. However, before jumping down that bandwagon, if you're in this crunch of hiring, I do recommend that you get creative as well, and that if individuals, if any of them are on pandemic handouts, that they may want to, this is a call for those who are unlikely on this call, but for those of them out there, that they may want to get back to work quickly if they happen to be on pandemic handouts before the opportunities no longer exist, as they being companies implement efficiencies or hire really remote. You want to make sure that you'll have a job to come back to. So that's on the one side of that cautionary note. But in addition to that, in addition to that, I just talked about all of this, sorry. So this could be more of a global impact than on local markets. So here's what I want you to take away from this, is that the data isn't all that it is. It's not being captured effectively. There's holes in it. And in addition to that, people are driving the jobs are driving the GDP, except that's not happening because they're quitting. Finally, what's not showing up is that the real estate cycle formula here, what we've got is that individuals are leaving their jobs. Individuals are getting jobs remotely. So that might mean that when we look at jobs data, it's actually not even freaking correlated. So think about this. Let's say someone popped it in there, hire Hawaiians. Okay, cool. Right, thanks, Alan. So if you're hiring a Hawaiian from Hawaii, they're in a completely different market. But let's say they're hired here, and it's showing up as a job elsewhere, because let's say the job is in Toronto and they're hiring externally. So the job is going to show in Toronto, but people are working remotely and the economy is actually being stimulated elsewhere. I apologize if that was a little long-winded to get to it, but it is really, really an important concept as we consider more remote working and not looking at jobs the same way, because they're not necessarily having the direct impact that we used to think that it did. A job in a location may not actually be contributing to the economy. So stay tuned. We got you. The jobs are they're definitely going down. They are not where they need to be. And as I mentioned earlier, on next Wednesday, you will get it. It is not just the Great Resignation, it's the Great Reshuffle. So what's happening is that and it's such cool data, and I love it because all of you are so smart. They're all of the cities in the US that you guys have asked for market analysis on. Where are people moving? And do you know how they found this data? You know how we're looking at cool data from like turkeys and how turkey inflation and Thanksgiving in the US is going to be like showing up as a buy signal for real estate investors? Well, this data is from LinkedIn. So they've reviewed LinkedIn and who's moving and changing addresses and what types of jobs, and frick, it's so cool. So you guys know a lot of where those places are: the Carolinas, Texas, Florida, Arizona, Boise, Idaho showed up. So there's a lot of different, which is so cool, and Portland, Maine. And I happen to have friends who have moved to both of those locations. So, you know, it's happening, and we're seeing it out there. So that'll be next week, but people are quitting and they're also moving. All right. So people, the think tank, oh gosh, guys. So this is fantastic. So a particular think tank goes in and they recalculate the US population. They knew that there was some undercounting, but so they had to go in and check it out. So anyway, what they found is that actually there are a whole bunch of Americans missing in their US Census. The typical folks that were not included as much as they should have been were people of color, renters, this is material for us, non-citizens, children, and people in Texas. So the population of Texas is higher than you expected. So it doesn't really mean that much for us as real estate investors at the moment, but there's two things. If the population is undercounted, that means that there's even more demand for homes, rentals, properties than we've been expecting. That means that when we talk about the lack of supply, it's even worse. The story is even worse because we didn't even have an accurate, we being the US Census, didn't have an accurate count on their population. And then indirectly, it matters to us because errors in population count, if they're significant enough, could start having an impact on immigration policies. It's kind of unlikely. I don't think that that's going to be the case, but it could be something. And if immigration is closed and remains closed, then that would eventually also cascade down to our real estate and potentially affect our values. So it's just something to watch and to be mindful of, that the problem is worse than we thought. Canada welcomed historic 45,000 new immigrants in September. All right, so Canada is getting back into the swing of things. This is really good. Yes, a big clap. It's the highest immigration in modern Canada, modern Canadian history, I should say. So this is very, very cool. However, oh, I know the however, gotta have fun. So the permanent resident arrivals, highest in the century, that's cool. And a massive increase, 200% increase compared to a year ago, duh. Like obviously the borders were closed and shut, so 200% increase means nothing. So it's not a useful comparison. It's still up 27% higher than 2019, which was our previous highest record of immigration. And we're seeing it in all the top spots, but also some movement towards Quebec and Manitoba, which we didn't typically see that happening before. So Ontario and BC are still the top spots, but individuals are moving to where there's affordability, which we've always seen, but Manitoba wasn't usually on that list. Quebec was. So the good news, we are starting to see a recovery in immigration. Why this matters to us as real estate investors is because that helps fuel our, potentially our tenants, they help fuel our real estate prices, and because and also rents. So there we are. But the bad news, this is the however I was getting at earlier, is most of the admissions were actually people who are already residing in Canada. So when they say permanent resident arrival, that doesn't necessarily mean that they've arrived physically. That it means that they've been their change of status. So this is great news. It's a step in the right direction. We're still below the 401,000 immigration target for 2021. Obviously, and it's just completely unattainable, because if we were, we would need 45,000 every month until, well, I mean, we're end of November. So yeah, we're not going to meet the target this year, but the targets for next year are big, and this is important to us. It's also important because the Real Estate Wealth Lab will be doing a report on the impact of immigration, specifically what we're forecasting as a hypothesis that because of the closed borders in 2020 and in through 2021, we will see an impact, a softening in the real estate prices in 2023, 2024. So that's the hypothesis, and we'll be testing that and writing a report so that you can have that. But you've been warned, so pay attention and stick with us. A couple of years ahead here. All right, so as you can see, in terms of people, it's not where it needs to be. It's barely going up, but it's on its way. It's on its way. All right, so the rental market, what's going on? So this is something that I have been looking at now, oh my gosh, at least 5 years, where the young and the elderly, the late boomers, yikes, I hate to say elderly, but anyways, the older generation, that they are competing for the hottest, and it doesn't matter if it says US rental market, because it actually is in Canada as well, that this is broad reaching, is that they want the same properties. So it's really cool, like amenities, the types of properties that they want. So people aged 24 to 40 are facing competition from those over 57. The Millennials and the millennials and the baby boomers are all wanting the same thing. Now I'm gonna just get to the next one here. Look at this. So this is a result, of course, of unaffordability. So a lot of the older folks generation they're selling and downsizing and going into cool places like this. And we have been watching this for years. So they want the same things. And that looks like resort style living. Like, this is the product of the future. And what I want to share with that is, for those of you who are REWL members, please go into the portal, and our member portal. I think I've got it coming up, but you're going to want to check out the Market Leaders Lab from this month. We talked with, it was just absolutely incredible, and we talked with Joel about adult living communities, senior living communities and complexes, and what's happening is creating these incredible vicinities, these beautiful developments, and this is what people are being attracted to. But guess what? There's this brand new trend. If you have not heard it already, there's a brand new trend of development called co-living arrangements. These are all ages, but they're basically like a multifamily apartment building where you have, it's almost like a dorm, but not quite that small. And with big, huge living places where you can, play games, watch movies, cook and whatnot. So this kind of lifestyle is really, really shifting. And we're seeing it in the younger generation as well as the older. So you're wanting to definitely look at that. I think that was, it was the last Market Leaders Lab. So at the very beginning of November. Maybe Paige, if you can find that, pop that in the chat so they can go and check it out. All right, so rents. This is super quick. It's just from Zumper, but what I want you to, obviously you're not gonna go through all of this data. But Kirsten, you're saying they've been doing that co-living in Sweden for ages. Yeah, well, and that's just it. We're in, North America is becoming very much like Europe insofar as a nation of renters. And these are the types of activities and co-living arrangements that are being brought from Europe here as well. Okay, next level real estate investors, what you need to do is, look at rent year over year. Look at it month over month. And that is what is really important, because this is indicating, generally speaking, if you're looking at the month over month, generally speaking, rents are down, softening. just softening. And then property values are going to be going also softening in the next few months. But when we talk about softening, and Rick, this directly is addressing your question that you sent in earlier. And his question was, I'm paraphrasing, but essentially how long, like you've been saying that properties are going to soften, prices are going to soften for a little while, you know, when should I time this? And, you know, how long is it going to last? There's a couple of factors, and I'm going to get into them a little bit later, but that are accelerating this. So properties are reducing, they're softening, and they will soften just a tiny little bit, but that doesn't even mean that they're going to go down in property price. Honestly, it just might mean that there's fewer bids. And there's reasons for that, and that's because inflation has been brought into our real estate cycle formula, and because it's going up at such a crazy rate, that is having a direct impact on the duration of this particular cycle. So it's not going to last long, and in fact, I'd almost say, you know what, forget it. Like, do not try to time this. Just, if you're doing buy and hold, buy. Like, these are major buy signals. I'll expand on that in just a moment. So this is exactly what we are expecting, and this is based on historical data. So these are real time and happening in terms of the lower month-over-month rent rates, but I'm not expecting them to stick around just because of supply and inflation. So the property market, this is cool. Home Depot sales. So I don't know if any of you checked out our Real Estate Wealth Lab Instagram, but we were talking about dumpster data. What the heck, you know, why would we look at dumpsters? Yeah, dumpster diving. It's important because there's a record number of dumpsters for renovations, like that kind of big dumpster, in basically in North America, but in the US is where they were specifically referring to. And what that does to property values, what that does to supply, it actually increases supply, it increases property values. So we're looking, and like I said, like we're looking at LinkedIn data, we're looking at dumpster data, because this is a wacko time. Like, there is no question about it. It's different, so we have to be looking at different information. So Home Depot sales, this is a gauge of retailers' health, but it's also Home Depot is home improvement for by and large, and that relates to our real estate. It's also, look at this, I love this meme. Like, how cute is that? House hunters be like, kitchen needs updating. I mean, this is a gorgeous kitchen, but people's like levels of, and even, you know, that resort style living, they want like really amazing amenities. They want their houses to be perfect. And they're also spending a lot more time in their homes after having been in them for the last year and a half. So that's been a spur as well. So renos, as I was mentioning just earlier, what do they do? Like, these are huge impacts on the economy, because not only is it the spending at the retail stores, the Home Depots of the world, but it's increasing your value of properties. It increases, which increases economic health and taxes, as we see, because you're also spending that money in the economy. It improves the community. Yes, renovations improve community, the social fabric, and also the taxes that go into a municipality that then come out as, you know, various pools or community libraries and things like that. It increases the housing supply, because stuff that people wouldn't have looked at before, once it's renovated, now they're interested, and it can come back into the housing supply. It improves that quality of life, it stimulates the economy, and it creates jobs. Home Depot sales. We start thinking about things just a little bit further, that next level of the full impact into the economy and even into money supply. So, but guess what? Don't all those benefits sound like really helpful? You know what? That sounds so helpful and good for everything. Let's tax it. So in Canada, of course, they are considering the flipping tax, and this is another report, and I want to say a big, huge shout out to Jesse, who has requested a report from the Real Estate Wealth Lab that we'll be working on in 2022 to understand the actual impact of flipping houses, flipping, renovating, etc., on the economy, so that we can, yes, leverage the information and connect with governments, lobbyists, other big institutions, and say, hey, this is really valuable. Like, it creates jobs. It does all of these things for the economy. Let's not tax it. That's next level. All right. The PwC report, the emerging trends, this is 113 pages. It's big. I am not going to summarize it for you today, but I do want to let you know that we're going to be pulling from it and extracting from it over the course of the next little while. It always comes out at around November. And it really, I mean, there's nothing dire that we need to go into here. I just want to let you know that it's available. You can get it. It's in the newsletter, the link to the PDF. So if you can go and have a look at it, it's definitely talking about the pandemic and how it had a relatively muted impact on housing, but that's because, so I don't know that they're thinking about it right. Oops. I love you, PwC, but I really think that they might be missing the mark on the impact of immigration, because the immigration that we saw in 2017 and 2018, 2017 immigration was super high, and then it went higher, and then it went higher, and those individuals would have been really coming into the market in 2020. And we just saw the market go up in 2020 and in 2021. So I think we need to really examine our legs, our lagging indicators, and there we are. But a little bit about what we see in the report and the muted real estate downturn. And I said, we'll unpack it, but about work from home, tenants didn't believe that this is what they're saying about it, that tenants didn't believe that it would last this long. Of course, not really anybody did. And firms, when it comes to commercial and residential real estate, firms didn't want to give up their valuable space and have it be only to be reoccupied. So commercial and residential property owners do need to consider physical workplaces going forward. And so making your space more attractive for workers, making sure that there's, and this is stuff that you guys already know, but making sure that there's, offices and whatnot available to your tenants. So inflation, I'm going to dive into this a little bit more because this is the most important impact and factor and indicator of our time. Yep. How to protect your money from inflation. So I just want to acknowledge something. So inflation is scary, and it really is. And so I make light of it often because, it's great for real estate investors, because I want to put that positive optimism on it. And it really is a buy signal for real estate investors. And I'll tell you more about that. But I do want to just be mindful that it can feel pretty scary. And Ken and I were talking about it earlier, and I've had lots of conversations with many of you about the value of our dollar going down. So where you might have wanted to buy 2 oranges, it only buys 1. And I was actually talking to my dad about this because he's lived through it and he's on here today. And he actually said, you change your lifestyle. In high inflation, when you've had to live through it, you do change your lifestyle. Now, that's not to say that you have to. We've got real estate, so we've got some hedges against it. But I just want to be mindful that when I'm saying, these are buy signals, I'm trying not to deflate the importance of inflation on our lives. But I've got some good news, so stick with me. So there's 5 key investments that usually outpace inflation. So please take a note of these. These are really important for you, for everybody. I'm living it with you. So the long-term equity investments, gold and Bitcoin, do what you got to do. And your home or other property is number 3 that typically outpace inflation. Inflation protected securities. And number 5 is your career. So this is really cool because it's a huge hedge. Your career is actually a very significant asset, particularly as wages are going to have to go up to keep up with inflation. So protect that as well. So remember back in January, they were all saying, it's just a 2.1% inflation, and it's just little, and then it's transitory. This is not transitory. Got it? This is sticking around, and it is a major run up. And what is awesome is that when they tell us the data that all the places where the data comes from, the CPI indexes and whatnot from the government, they typically take out all of your household goods. Perfect. So it's scrubbed of anything useful. So don't look at that shit. You got to look at this other stuff because it is really, it's incredible, and it is going through this. So Now that we know that inflation is running up, what can you do about it? So how does property, real estate, and you know, this is a really, again, it's a major buy signal. So you're going to want to talk to individuals too to help them prepare for their financial future. Because it is one of the most stable asset classes in turbulent times, outpaces inflation. So how? I'm just going to give you some quick highlights. Owners pay the mortgage loan back with money that is becoming less valuable. So your mortgage actually becomes quote unquote kind of cheaper. At the same time, inflation drives up the value of the property more than just like normal appreciation. It goes up even faster. In addition, rents also go up. Of course, there's rent control. Gosh, I don't know if I've got that in here. I think I do, but I'm getting ahead of myself because, okay, you guys know what happened for rent controls for BC and Ontario, for example, for this year. Yeah, they're not good. They're like, it's ridiculous. So I'm going to be watching this so closely for next year because they're supposed to, when they calculate rent controls, take in the CPI index, which of course they scrub with households, but they are supposed to take into account inflation. So technically rents should go up, but at least if you're able to get a new tenant in, they would go up. And they're a hedge. So fixed rate mortgage right now is definitely a good inflation hedge. The average 30-year mortgage in the US is around 3%, but home prices just this year rose around 15%. And this is all going up. And there was one more thing that I wanted to say about owners paying that mortgage back. Oh, right. So it's leveraged even more. So you've got a property, it's going up. It's going up more than it's ever gone up before because of inflation and appreciation. And you've got your mortgage, which is technically becoming cheaper. And you've got a lower mortgage because if you've got a locked in mortgage at some point and you're going to keep your term, you'll have a huge spread. And that is really, really powerful. I hope you got that. That's very, very powerful. So protect your money. This is a buy signal. This is about turkeys being another indicator. Expensive Thanksgiving in the US, airline prices are up, everything's up. All the federal governments everywhere are saying that it's transitory and temporary, but it's not. Inflation is real. The reasons are not, though. There's a lot. This article is actually very, very cool. I do recommend you read it. Because in this particular article, American Consequences, and they're backed by Stansberry Research, which is really, really cool, incredible. They're saying that inflation is caused by COVID-19. No. It's a government response to an emergency. The virus itself did not cause inflation. So just be mindful of those words because it's not that. It's the government and how they've, responded, rightly or wrongly, who knows, but there's a lot of printing of money. And back to Rick, your earlier question too, about, this printing of money causing inflation. It's just because it creates it so much more of it that it's devalued. It becomes less valuable. So the rhetoric needs to shift. It is not transitory. It's here to stay. And we just need to be prepared for it and buy real estate. So hopefully, I hope that you can also use this as next level real estate investors for your people, your family, your friends, your clients. Like these are all really important matters at stage. Oh, Tara, language builds the house that you live in, and they are wanting to paint a picture. That's right. Just be mindful of what language they're using and what may be a different way to characterize something similar. All right, where am I? Politics and policies. Okay, so Congress approves a $1.2 trillion infrastructure bill in the US. Pretty massive. There's lots of money out there for infrastructure. There's a lot for technology as well, and internet and whatnot. So we want to also watch for more inflation. There's a couple of things that are happening here. When we talk about transportation infrastructure, that is very material to you and your real estate. Roads, bridges, pipes, ports, all that kind of stuff. They typically drive up the real estate property values in the general area. There's kind of a macro and a micro situation happening there. So I won't spend a lot of time on it, but be mindful of where those monies are being spent because you'll want to get as close to them as possible. Post-election changes in Canadian real estate, right. So the affordable housing platform, oh, reminder, it's a minority government. It's not a majority government, so they all have to agree, and they're all agreeing, all the parties are agreeing that they want to have affordability. However, what they've also done is implemented some new first-time home buyers savings accounts, just some new incentives. So you want to check those out if you've got first-time home buyers, and decreasing in mortgage insurance, etc. So what is this doing? These think about what these first-time home buyer incentives, all of these here, tax credits, etc., are actually doing to housing affordability. It's increasing demand. That's not helpful. We've got a supply crisis. It's exactly, Hugh. It's making it worse. Frig, it's going to drive up the prices. This does not help supply. And the measures that they have suggested about improving supply. Oh, look at the little face palm. Yeah, I added that. This is a definite problem. All right, so what we do need to understand, though, is that the implementation, what they're recommending to address supply, it's just a lot of hot air. And the reason for that is because they don't have the jurisdiction to implement these solutions. So they really don't. There's an opportunity here and there, of course, where they could, do tax credits or incentivize developments, but it's at the municipal level that most of these occur in terms of zoning, in terms of bylaws, all of that. It's not federal. Very, very few of the recommended ways that they would increase supply and address affordability are something that they can handle. And so we've been talking about this since our very first research lab in September. And now, 2 months later, it's making headlines. You'll see them everywhere. Jurisdictional challenges. Yeah, we saw it. So I actually recommend, I don't spend a lot of time on it. Do go into your member portal, have a look at it. We talked about it at an overview in September. And then in October, actually went through each of their policies and said, they can't implement this, this is provincial, this is municipal. So unless they get a major cross collaboration of all levels of government, supply isn't happening. But thanks for increasing demand. Awesome. Weird. Oh, I just told you all of that. So yeah, we got to dig deeper into these proposed policies. All right, so I think, Rick, pop it in the chat if I answered your question in terms of the duration, in terms of the impact of pricing, because we had been talking about properties going through a softening for the next few months, and it is still possible. But because of now we're looking at this lever of inflation that's just going way up, and because of the supply situation that we're just seeing now that they're increasing demand even more, and immigration is now starting to come back, we are really unlikely to see much of a softening, if any, in real estate prices. So again, all of these are buy signals for the long term. We're in it for a long time. So ladies and gentlemen, that was your real-time data, real-time analysis and insights and next level intelligence. So thank you very much. Awesome. How are we doing on time? I think I'm doing all right. All right. Are you ready? Awesome. Thank you, everyone. Really appreciate it in the chat. And now, are you ready for your very first U.S. market analysis? Right on. Okay, this was like the number one thing that next level real estate investors want is U.S. real estate and how to. Now, that's super, super cool, because you're freaking smart. And I'm going to tell you, I'm not going to spend a lot of time on this because this is we've got here. I'm actually going to show you right now. Yep. This book, Buying U.S. Real Estate, authored by Richard Dolan, Don R. Campbell, and David Franklin. It's 273 pages. And you guys know what I do to books about real estate investing is unpack them in a way that's meaningful and insightful. And Mona, I will comment on Airbnb. Sure. Actually, I'll do it when I talk about Hawaii. How's that? So 273 pages, and we've got hundreds of years of combined U.S. real estate experiencing just on our Real Estate Wealth Lab team. Me alone, I've been investing in the US for 11 years. There is a lot to cover. It's really important to set it up right. I know, Hugh, you're in the midst of it and working on setting up your power team and whatnot. And there's a lot to cover, but it's all doable and it's freaking smart. So I'm going to tell you how smart you next level real estate investors actually are. So we are going to be answering what, where, when, why, and how. These are some of your questions. Corporations, what kind, where, structure, cross-border taxes, cross-border accountants. Hey, I'm going to just pop in a real quick hint here because I know some of you are in the middle of this right now. It's not just a cross-border tax accountant. I also want you to make sure you have a local accountant in the state or in the city. It's got to be in the city or the county, actually. Pardon me. It's at that level. It's not just at that state. That's really, really important. Why? In Hawaii, for example, Maui just implemented a brand new tax on like 2 weeks ago, but Oahu has not. The City and Council of Honolulu has not. So you need to know at that level, your cross-border tax accountant ain't gonna know that stuff. So you got to have them all working together. Awesome power team, people. How to choose a market, your state and municipal restrictions, the pros and the cons to investing in the US, terminology. There's a ton of stuff that's like basically the same, but they use all different words. So making sure that we know the terminology and escrow and all of these things. Mortgage qualifications are totally different for Canadians. You get less typically. It's a loan to value ratio, typically a 60% loan to value. So you got to be prepared for that. Of course, everything's different, but just be mindful. Renovations, flipping taxes. What about commercial real estate in the US? And by the way, I have a big background, believe it or not, in US industrial and commercial real estate back in my corporate life. So I actually have done US industrial development and whatnot. So I do have a lot to bring to the table on that, but we've also got tons of experts who will be able to bring you up to speed on it. And then also the impact of lifestyle real estate investing. This is huge and it's growing. And as we talk about fractionalizing and we talk about, I saw Troy, you're on here, we talk about, and Vincent, of course, our Chief Technology Officer, what does it look like to do fractional Bitcoin tokenization of real estate? And how is that you could do that in commercial, residential, industrial, lifestyle real estate investing, senior housing, all of those are doable and more. So as you can appreciate, not going to get to this all tonight, but we have got you. We're the only ones in Canada telling you how to do it and do it right in terms of investing in the US. All right. But here's what I want to really talk about, you guys, because you've been asking for this. I wanted to share this article by Kim Ixkian. I hope I'm pronouncing that right. It's really cool. And it's just like, why would we bother? Like, let's just start with that simple question. Why are you next level real estate investors interested in investing in US real estate? Pop it in the chat. Why do you care? Cash flow, very good. Okay, gotcha. Yeah, typically it is easier to get some cash flow in US properties. Very good. Better returns. Dollar exchange, woo woo. Affordability, better return. Lower taxes, diversifying. Kirsten. Deanna, US income stream, no currency and conversion loss, exactly to pay for that lifestyle when you're over in Palm Springs. More in migration and lower cost properties, more understanding on what and how. Beautiful weather in Florida. These are all freaking amazing answers. Warmer places to visit, whether it's in the Sun Belt or Hawaii or Florida. Better financing options, Julius. That can be the case. It definitely depends on if you've got a green card or not. But anyways, you got it. So the weather and all of these other components. Thank you very much. All of those reasons are awesome. And what I want to share with you is that, first of all, what the heck is an offshore entity? So let's just assume that we've got it, in a company, it being real estate, in a company, a trust, or some other account in a way that's being called an offshore entity that's held in another country other than where the owner lives. Now, people use their tax sheltered playthings to hide cash, real estate, shareholdings in companies, trusts, and lots of other assets that are worth something. Now, that kind of sounds nefarious as hiding stuff, but in fact, newsflash, quote unquote from Kim, newsflash, offshore done right is perfectly legal. So do not have anyone misconstrue any of this. And in fact, you'd be foolish not to keep some of your assets somewhere else. Foolish. None of you are foolish. You are all next level real estate investors here asking the right questions at definitely the right time. So why would you do this? Assets in another country can legally protect you from some things, shield you from unscrupulous associates or even extortion attempts. They can help ensure inheritance for descendants. They can provide additional security. They can reduce investment risk. And here's where I saw it in the chat. I'm sorry, I forget who popped it in there about diversifying. And diversification is so important, and we stand by that at the Real Estate Wealth Lab. It is so important. You need to absolutely understand your markets right down to the frickin' neighborhood, 100%. But we also need to be super mindful of the diversification of industries, across industries. So medical to manufacturing, that kind of idea. Asset types, geography. Think about how politics comes into play. That's diversification. Diversifying countries is diversifying politics. It's diversifying policies. It's diversifying currency, which you guys popped in here. It's also diversifying international relations and diplomatic policies, which all have impact on your real estate. It also is diversifying against climate impacts. I've got a ton of property in Abbotsford, but I also have a ton of property elsewhere. So not everything has been flooded today, this week. That is very helpful in terms of additional geography and diversification. Diversification of laws and diversification of palm trees. Since weather was in there as one of your reasons, I'm so glad. I was just kidding, but not kidding, because palm trees on the east and the west, you name it, all in between, why not? So, quote unquote, diversifying your assets by using offshore entities is a necessary instrument in any smart investor's toolbox. So, ladies and gentlemen, welcome to the ride, US Real Estate How To 2022. We're going to make 2022 our pitch. Yes. And we've got you covered. So we're going to be unpacking it. It is a very similar process to Canada, but you want to start, what you need to know right now is to start assembling a superior cross-border team. If you're considering it, you need to start interviewing people, all the same kinds of folks that you would need on your Canadian team, property managers, realtors, lawyers, definitely lawyers. And we're going to have lots of recommendations for you so that you can understand what kind of structure. But understand what you want the real estate to do for you first. Are you doing a lifestyle play? That's going to be different. Are you doing it so that you can have a palm tree home in Hawaii or Florida or wherever and be able to visit it? Or are you wanting to get into commercial? These are important questions because it will absolutely guide your lawyers and your team on how you structure. So think about those. And hanging out with REWL, because we're going to be going through and providing you with the macroeconomics, the politics, the policies, the market analysis, and the how-tos for Canada and the US all throughout next year. And very specifically, yet unspecifically, now is the time to buy US real estate. You're in the right place. It absolutely is. Of course, you've got to have your specific types in specific markets, because apples do not equal oranges, but it is a very, very good time for all of those reasons of diversification that I just went through. All right, now we're going to get into our first market analysis, Honolulu, in line with our US real estate. So we're starting all the way out in Pacific Islands on the west, and GDP in Honolulu. It's okay. I'm gonna get there in a second, so I won't go there now, I guess. So United States real GDP growth is 5.7% for 2021. That's what we're expecting. And for Hawaii for 2021, 2.7. So This is below the national average. So that is not necessarily a good sign. But this is where I want you to really put on a different hat, because the state of Hawaii, so I'm going to put it this way. The state of Hawaii is not necessarily a place that I would go to and invest in a multifamily apartment building or commercial or industrial. However, if you're using this as a lifestyle real estate opportunity, if you want to be using your asset and going to Hawaii or having your friends go to Hawaii or whatever, then it's this. There's some great news in here. But if you're literally just looking for a massive multifamily, huge ROI, go elsewhere. This is not the place for that. So straight up. However, so that's where you got to be looking at it. And that's why identifying what you want your property to do for you is important. So here we've got slow net real GDP growth. It was down 8% for 2020, up 2.7. So the net, it's still decreasing. But we're going to get into it. It's important. I should jump ahead, but anyway, I won't. What's important about this, guys, is that Hawaii's economics and their diversification of their economy, it's 21+% based on tourism. And it's like, I think that's even a low estimate. So of course, with the pandemic, that shut everything down, and it hasn't been able to recover because it did a little bit in August and July, but in September, they shut down the doors again, and October, and they're only just reopening them like now, Thanksgiving-ish. And again, there's still restrictions for vaccinated and non-vaccinated and things like that that are slowing it down. However, now there's some things that are also showing that this is a remarkable time to get in before all of the folks come back. So Entertainment Tonight is spotlighting Oahu, and So What? The TV show has nearly 4 million viewers a day and a major social media presence, and it's expected that this is going to help jumpstart Hawaii tourism on top of the pent-up demand, which is really important. Hawaii is going to get 2.8 billion, remember that $1 trillion infrastructure, so they're getting 2.8 billion to support their roads, bridges, internet access, and new jobs. So it'll be worthwhile checking where the infrastructure dollars are going to be spent. Are they going to finish the light rail or not? Those kinds of things, so that you can target your real estate acquisitions around it. Here's what we got to talk about with tourism, is that the experts, so because our economy is so focused on tourism, and that's a good thing, but it's not a good thing. So it's a different, because you want to have economic diversity, but it's such a strong economy that when it opens, it's going to be very remarkable. And the tourism experts are wooing international travelers back, and that's going to be coming. But I got some statistics on what's actually happened this year. And guess what? With the closed borders, the international travelers, so typically tourism for Hawaii comes from Asia. Japan, Korea, China, other locations in Asia. And that's the big, and Australia and New Zealand as well. Huge tourism industry to Hawaii. But of course, the pandemic restricted all of that. So what happened is, and then the US folks, the mainlanders, they're called, the mainlanders couldn't go to their normal spots. The Caribbean, for example, on the East Coast, or they couldn't go to Europe. So guess what? They all came to Hawaii, because that's a domestic flight, and that was a domestic vacation during the pandemic that they could go and get their Mai Tai and enjoy the palm tree and the weather and have that wonderful vacation. So they adapted. What's happened is a mix. It's changed something about 142%. I mean, it is ridiculous, the change of the number of American mainlanders. So what's happening is, and the international travelers haven't even opened up. So we've seen a massive gain in tourism. I think that this is coming up. Oh, here we are. Yeah, look at this. So daily visitors, of course, the percentage is ridiculous. September 22, 2020, 11,000 visitors. I mean, that's ridiculous. There's typically something like 30,000 a day or whatever. September 2021, 246,000. I don't care about the percentage change because, of course. So this little picture here says they're back in terms of tourism, but guess what? This is almost pre-pandemic levels, and it's not open to international travelers. Like, let that land. American mainlanders are coming to Hawaii in droves. And once they've tasted the aloha, they are absolutely buying. They're wanting to stay. And we're seeing a massive, massive change coming up. So the visitors also, we've got a breakdown of a really cool breakdown. I'm not going to go through it all today. There's tons of stats for you if you're interested, but that they're spending 1.37 billion. And again, this is based on just mainlanders. And so the mainlanders spend less than the international travelers per day. So as you can see, the economic recovery that is about to be unleashed on these islands is really, really, really crazy. And one would think that, so what's also happening is development of more hotels. There's whole areas, in addition to Waikiki, of course, the main one downtown, like on Oahu, that the island where Honolulu is, there's so much more going on that hotels are bubbling up. Hotels are in development. Well, they're preparing for this wave. So we want to be ahead of it. If that's something that appeals to you, you definitely want to consider Hawaii. These are all buy signals for Honolulu in particular. And I'll talk about that in just a second. So tourism is recovering again. Travel restrictions are lifting again because their economy has been doing this for the last little while. More visitors are arriving. Again, that mix is mostly Americans. Hawaii is top 3 most popular location in the US to visit. I've got the data for it. And that tourism mix is that huge COVID opportunity. So here's where we're at with jobs. It's just been on and off, on and off, on and off. The job market is super struggling because of this inconsistent, you've got, like, the rules for all of the tourists are changing constantly. Do you have to quarantine for 10 days? Do you have to quarantine for 14 days? Do you have to quarantine? Which kind of test do you need in order to get on the flight? Like, it's constantly changing. And so that's had a really big impact on jobs. And like we've seen across everywhere else, that there's major job markets that have been dealing with resignations and of course the impact of the stimulus checks and whatnot. However, all of the experts are expecting the job market to rebound next year, 2022, very significantly as tourism opens up. We've got a monthly job change. Honolulu added 3,600 jobs in September, which is the highest growth in 5 months, which is very cool. But then it instituted a shutdown right after. So again, we're not out of the pandemic and the implications for that yet. And I mentioned the labor shortage problems and the federal stimulus money. All right, so people, where are we at? This is very important as a real estate investor, is having the population to support it. And my humble opinion is that smaller towns can perform really well. They can, but you do need to be mindful that they can add an extra layer of risk. So Honolulu, as opposed to the state, population growth rate, and compared to nationally, the United States, Honolulu is up at 4.1% growth rate. Hawaii is only at 2.7%, and United States is 0.4%. So Honolulu, that means it's growing faster than the national average. That is good for protecting, for having tenants, for protecting the economy. And what was a really interesting surprise, because I was looking at this, I did a huge market analysis of Hawaii about 3 years ago, and Maui was growing faster than Honolulu at that time, but it switched. It doesn't have the economic diversity. It doesn't have the seat of capital. The government jobs are not there. So this came as a bit of a surprise for economists, but it's not such a surprise when we consider that the infrastructure is on Oahu. So Oahu's population is also the largest of all of the islands. It just topped over 1 million now for the first time. And the slowest growing is in Maui. So I know, and this isn't trying to be a Maui camp and an Oahu camp or whatever. You just need to be mindful of all these stats. And we're going to get into Maui in just a sec. So in the rental market, we are seeing a slight rent increase. Not in line with inflation just yet. It is a lagging indicator, and so it's a soft increase as one would have expected because of the precipitous drop in GDP in April 2020. We foresee these going nowhere but up as work from home individuals are moving here and you name it. What you need to know about the battle against short-term rentals. So if you are wanting to, and the question earlier was talk about Airbnb. This is something that you need to do in every city. If you're thinking about doing a short-term rental, you need to get into actually, yes, I invested in Hawaii, I have been for 11 years, and I attend the Department of Planning meetings. You absolutely will want to know the zoning, and especially short-term rentals. It's not just Airbnb, VRBO, whatever, that are the restrictions that are imposed on, especially if you're considering a palm tree location and getting tourists in for that sort of transient type of accommodation. So what's going on in Hawaii is that there's a pretty significant battle against short-term rentals. The good news is that they've taken it so that it's really about the ones that are in residential communities, in the residential areas, and that's where they're cracking down on here. What you need here, being in Hawaii, what you need to know is that there's certain zonings, but also certain buildings. So it's very important. I want to put this as an action here, as a warning. You do not want to enter Hawaii anywhere, because this is in Kauai as well. This is in Maui. It's on all the islands. You just make sure you've got an on-the-ground expert to help you navigate, because it's not just about the zoning, it's also about the building. Once you know that, you're good. It's all good. It's a great opportunity. But if that's your plan, you need to make sure that you're prepared for it and get all the information. And as I mentioned, for example, like Maui just implemented a brand new tax. Got to know all of those local things. Property market. So remote work has made Hawaii's real estate market tighten even more. So why not? People are really remote, and so they're coming out and doing their work out in a tropical location. So why not choose a tropical idyllic office setting? And so that's something that's demand for Hawaii real estate is escalating dramatically. We're starting to see quite a few of bidding wars that's starting to happen, and a lot of individuals are just buying sight unseen from the mainland. So decreasing days on market, inventory is shrinking, and there's about 1.2 months of inventory. And typically in a large city, just so it gives you a bit of like a context, 1.2 months of inventory is not a lot. Typically in a balanced market in a large city, you'd look at like having about 6 months of inventory. So all of these are showcasing that the Honolulu is on the rise. Hot Oahu real estate market shows no signs of slowing down. The median home prices is more than $1 million. Properties have appreciated since, oh my gosh, I can't believe I'm going to tell you the stat. You ready for it? Since 1971, properties in the Waikiki area, generally speaking, have appreciated, I think it was something upwards of 1,300%, 285% since 2010. And there's hardly any new construction. So supply, demand, economics. So now getting into Maui, very similar in terms of structure and whatnot, but there's a few complications about Maui that it's awesome. Again, if you're doing lifestyle real estate investing, that's cool. Just be mindful that there's even more restrictions, even more taxes in Maui for that kind of accommodation, and you just have to navigate it. So daily, and also there's fewer tourists, there's fewer people who are living there, the population is lower. So just keep that in mind. So the daily visitors are up huge. This is fantastic. As you can see from the pandemic to September, again, their economy is very much based on tourism as well. The Maui arrivals dip 18% because of, but domestic travel stays strong. So again, we're talking about that mix of domestic within the islands, as well as some of the mainlanders that's occurring. What is this? Council's resort condo plan may increase property taxes. Well, yeah, this is happening. So there's taxes that are going up in Maui. Now, with regard to jobs, again, similar situation, kind of weak because of the tourists and the lack thereof because of the pandemic restrictions. The hotel and food industries are massive to the economy in Maui. They are planning to expand their economy into having kind of like a breadbasket, if you will, into some major agricultural lands, but they haven't done it yet. So while they've got farming as a key one, it's not as expected, but we are expecting next year it'll rebound even further. Here's your employment rate. I mean, this is all pandemic related stuff, as you can see, that would impact a tourist economy. So Maui saw a decline in payroll jobs last year, of course, pandemic. So why does it make sense for many to move away from Maui? And what's happening is that a lot of individuals are moving out of Maui because they're seeing opportunities on the mainland in the US, but also in Honolulu, because that's where the majority of the jobs are, the people are, and the resources are. So with regard to people, the county population could decline with job losses. A lot of individuals are leaving that location, and it's the highest in the state. I guess Maui lost more than 20% of their jobs last year, which is the highest in the state of Hawaii. So we just need to be mindful of Honolulu overtaking Maui's growth rate since 2010. There was a little blip there where I thought maybe Maui's gonna go and attract lots more, but you can see with Hawaii having 1.4 mil, Honolulu County 970, Hawaii, having 1.4 mil. These are back in 2019, and Honolulu is now over 1 million, and Maui County was 170. So as you can see, it's a very small population, and that is something that we need to be mindful of. Rental market, I'll just mention here, it's a little bit on the rise. These are your average rates for an expensive area and for a less expensive area. What you'll also want to know about doing a market analysis in the US is that data sources, because I know that was something that Real Estate Wealth Lab members wanted, is the data sources. They can be a lot more challenging. And Vincent, our Chief Technology Officer, and I, and his whole team, we're looking at really getting these sources to be just at the tip of our fingers, and maybe if we talk nicely to Vincent, available to you members as well, so that you can run your own numbers. Real estate market, what you need to know here is that it's growing just like what we saw in Honolulu, 146% increase in home sales. The sales are up 28.5% compared to Q1. There's inadequate supply to meet the demand. We're seeing that across the board in North America, and it's certainly the case here. A whole bunch of individuals are buying some interesting real estate in Hawaii right now, including Oprah and some other, who's that guy? Oh yeah, the guy who started Amazon. Anyways, there's quite a draw. The average home price increased for 41.6%. And again, there's just limited inventory in Maui. And again, all of these statistics are available to you in your member portal, so you can come back and look at them and check them out if that is of interest to you. So then the days on market dropped, so they're dropping as well. So things are hot, and they're going to get hotter, as I mentioned, in all of the state of Hawaii. So when we look at Maui specifically, in conclusion, and Honolulu, Maui has less economic activity, has less diversity, has fewer jobs, and fewer people, quite significantly fewer people. All of those things are not really like good safety risk factors, de-riskers for an investment. However, if you love Maui, because those of you who love Maui and this is your dream and that's lifestyle real estate investing for you, absolutely, there's ways to navigate this. It's definitely good, and you're going to want to buy it sooner rather than later, because demand for it is just on the rise, and it's not going to go anywhere. Demand is going to increase for a long time to come. Similarly, so Honolulu, Waikiki is the most popular, it's the most populated, it's got the most economic diversity, jobs, people, you name it, research facilities, universities, stadiums, all the things, the infrastructure, transportation that really help support and mitigate risk. Of course, the ports, the cruise ships, the terminals when you're shipping things here, all of that. So it's a lot less risk. There's huge opportunity right now in Hawaii. Their foreign exchange rate, this floodgates, I cannot emphasize it enough, the floodgates of tourism are about to open, and just wait until this pent-up demand from international tourists arrive, whether it's just to come and stay, to visit, or if it's actually to come and buy and stay. So there's definitely a huge lifestyle real estate play. You can own that dream, but I definitely, if you're looking to just buy, a big, huge return on investment and do a big, huge multifamily development, there's a lot of layers here, and I wouldn't recommend it for those purposes, but for a lifestyle, definitely. So there you are, ladies and gentlemen, that is your Aloha market analysis for Hawaii. Lots of opportunity for the right location and for the right type of property. And in conclusion, for everything we've talked about today, US and Canada will likely experience long-term housing price stabilization and expansion over the course of the decade. We are forecasting 2023, 2024, a little softening, and we do need to be mindful of continued impacts of economic recovery amid the COVID. Inflation. It is such a major buy signal, and stick with us because we're going to help you navigate it. Interest rates will be going up eventually, so another reason for buy signals. And more on US real estate investing coming your way as you've asked for it. And again, thank you so much for all of your support and becoming members and choosing us as your free trial. So we'll look forward to seeing you at the community lab where you can learn more. This is going to be, thanks everyone, I appreciate it, mahalo. You're going to be able to have an opportunity to explore us, to ask questions, to apply our calculators, bring your own deals, bring your own information, because we're going to be there to support you implementing them in those calculators. So that's December 15th, 7:30. And you can follow us on Instagram, check out some fun videos at Real Estate Wealth Lab. And thank you again, ladies and gentlemen. Join our free trial, please, because we want to see you so that you can help take 2022 by storm. And that is everything. Wonderful. Thank you. Stop sharing. Whew. All right. I don't know what time it is actually, but I'm open to questions if anybody has any questions. On what? You can pop them in the chat. Do questions for a bit. Or is everyone pooped? Mona, you just wrote Florida. We'll be doing that for sure. Can you buy fractional real estate in Hawaii? Yes, Vincent, actually. Well, thank you for asking. In fact, that is my other company, Ventures with Adventures, about fractional real estate in Hawaii. There you go. So you don't have to go all in.
Hey, Jen, it's Naran.
Hi, Naran.
Hey, I'm just going to come into the call for just a minute here. While
Sure.
People are thinking of questions, I know there's probably questions out there. People may be feeling a little apprehensive about coming in. So just want to throw something out. I had coffee with one of our REWL members this past week. And in my conversations, what I've found is that those of us who are part of this group, like Doug, for example, I think he's still on the call here, we're all very busy and we're buying a lot of properties. What you do really well is you create a shortcut to intelligence for us. And that is so powerful. It allows us to raise capital better. It allows us to invest faster and with confidence. So the stuff that today's the first call I've been on where I'm not involved directly. And so I've been able to listen from an investor perspective. And I'm just floored and appreciative of the content that you put out.
Thank you.
Thank you.
Well, thank you, Naran. Appreciate that. And we're just getting started. So thank you. I really appreciate that. And that's what Real Estate Wealth Lab is here to do, is to support next level investors. And I see, Louis, you've got your hand up. I think you can unmute yourself. That would be fine. No? Oh, yeah.
Good. Thanks, Jen. Another great call. I just wanted to ask, do you think it's possible for next year sometime to put something together maybe for crypto and its relationship with real estate and how we can possibly make transactions in the future, because I think it's definitely up and coming. I'm a big crypto fan. I've been investing for many years, and I think it's something important to cover in 2022. So just wanted to shout out about that.
Awesome. Yes. And I see Troy just put a little yup in there, and we're talking next week, and we've got some folks who are already doing that, Lewis, that we'll be bringing in some experts to show how that's done. And also one layer more is beyond the crypto, but also the tokenization of real estate, which is like a fractionalization of real estate through technology. And Vincent, our chief tech officer, and that team is all over it. So the answer is 100%.
Wonderful. And who knows, maybe one day we'll be doing a call on buying and selling virtual real estate as well.
It's a whole nother level, isn't it?
Thanks, Jen.
Thanks, Louis. Great one. James, I see you're saying that you have a question, but you can't unmute. So pop it in the chat for sure. Mona, you're saying active seniors. I'm just going through Maui prices up. Yep, since 10 years. Yes, Maui prices are up. Everything is up. There was a little, I'm not so sure about Maui, but in Honolulu, there was a little bit of a blip for sure last year at the beginning of the pandemic, but they're all coming up. And significantly, it's pretty good. Pretty good. Interested in the best cash flowing rental markets in the US. Kareem, great. Well, I have a list. I can give that list to you right now, but you'd want to do your market research for sure. But some of those areas are like Phoenix is fantastic for sure. A couple of places in Texas, the Dallas, the Houstons. I'd have to look more. We're gonna do Florida, I think, next, so we'll look into that one as well. But because I'm seeing these trends, and especially as I mentioned earlier about that LinkedIn data with a number of individuals who are going like just the great reshuffle after the great resignation, the Sun Belt is really, it's huge, and that's where we're going to see some interesting market increases there. So you'll want to do your diligence, but those are some of the areas that you can get. It's not just about the cash flow, because you can get cash flow in really risky locations. My very first property was in Detroit. So yeah, I could have gotten great cash flow with that, but there's some risk factors that go into it. You need to make sure that the population, the economy, the jobs, the diversification, and then about 20 other indicators that are all working there for you on your behalf. Palo, Atlanta. Yeah, that's great. We're taking a list of tons of locations for sure. So that sounds good. James, my question is, you refer to lifestyle investments, but I get the impression the returns are not as great as, say, a multi. Is my assumption true? What kind of returns are realistic in a vacation property? Yes, 100%. A multifamily apartment building will definitely have a higher, I can't say definitely. Oh, no, you can buy some really shit multifamily apartment buildings, okay, and get yourself into trouble. So it really depends, and I hate to say that, but it's a different kind of investment. Many multifamily apartments, like, is that something that you would want to live in and have that vacation lifestyle? Or do you want a property that is like more of a vacation location? And that's what lifestyle real estate is about. It's quite different. And the returns are actually pretty impressive, to be honest, because you're actually using the property as your vacation. So you're saving money on your vacation. But it is different. It's a very different component. So there's investing in the US real estate. That's where you have to understand, what are you doing it for? You might want to do it for multiple reasons. So for example, I like to have multifamily apartment buildings, but I also want to have lifestyle real estate. So not all properties and asset types and locations are created equally. Just know what you're getting into in a particular market for. So for example, I kicked around the idea of buying a multifamily apartment building in Phoenix, and then using that as my vacation place. That didn't appeal to me. The properties that were, where I was looking, they weren't resort style enough. That wasn't the experience. Does that mean I'm not going to buy in multifamily in Phoenix? No, I probably will, but I'm going to be buying it for different reasons. And that's why I like my Hawaii real estate for vacation. Hope that answers your question. Oleg, I just bought a house in Jacksonville. Price points are much better than some other locations in Florida. Yes, you got to be careful about Florida. The interior of Florida is something to watch out for. So you want to go to the big cities, and Jacksonville is one of them. So that's awesome. And Orlando. Nito, see you raised your hand. You want to unmute?
Hi, Jennifer. Can you hear me?
Hello. Yes, I can.
Hi. Sorry, I'm driving, but I stopped. So just can I ask a question?
Of course.
Probably a lot of people here have experience in real estate, but me, I'm kind of like a new, and thinking of starting. And I want to know if the Wealth Lab will be able to provide kind of guidance and in terms of finding great deals, in terms of finding mortgages and all that.
100%.
For somebody who's new.
Yeah, 100%. For, and congratulations and kudos for joining us. Especially as somebody new, that you'll find that probably our conversations, they may feel a little overwhelming. So I just want to mention that, because we talk about very different things like macroeconomics and like weird stuff and inflation, when you might be like, I just want to buy a property. It's okay. You're in the right spot to take your real estate wherever it is to the next level. And so what I can share with you is that we've got a huge resource and an amazing team. We've got advisors behind the scenes, and we're actually working on putting together a property shop, Vincent property shop, so that we can actually share deals with one another. And actually you'll be able to have conversations with people who can help you navigate them. Those calculators, I wish those calculators existed when I first started. I got to tell you, they're a lot easier to use, and those will help save you a ton of time. They'll help you assess a property, like the quick analysis of them to right into whether they're going to be a good deal for you. So there's tons of support, and you're in the right conversation for anybody who's considering real estate. So I hope that helps, Nito, and I hope that you join us for 2022 and beyond.
Oh, great. Thank you.
Awesome. Thank you. And Julius, I see you've got your hand up. And maybe just one or two more questions, because I think folks are feeling like it's time to go.
Well, Jennifer, it's great for your presentation. I always love listening to you. It's a lot of great insight. So thank you very much.
Oh, thank you.
Yeah, and I guess it's really my questions, or maybe these are really on the rich list that I have. Maybe you can go over them in the future. It's a lot to get into. Love hearing about Hawaii, because I think really the first time hearing about it. Some of the question I have would be like, how do you source a property? Let's say if you're looking for a new property, right, or your next purchase, is it going to be an on-market or off-market purchase? Right, that would be a key, because off-market in the US is another much bigger thing than Canada.
It's so fun. I've got some really cool tips and tricks for off-market in the US, and wow. But carry on. So go ahead.
Oh, well, no, I have a lot of fun with off-market properties in US as well. Awesome. And also because then I also just did my Google search, and Hawaii is an attorney state versus a title company, escrow state. So there's some technical differences in terms of how to actually conduct the buying process. So I definitely would love to learn a little bit more about it. And I'm a very number-oriented guy, so I'm always curious about the cap rates that you can achieve through a long-term rental versus a short-term vacation rental. And also happy or love to hear more about the property management aspects of managing those properties, which I'm sure you're going to get into it in the future. But
yeah. Well, it sounds like you and I should have a conversation about Hawaii separately, because there is a lot to cover for Hawaii. For example, to be a property manager in Hawaii, you actually have to have a real estate license. You have to be a realtor. So you're right. Like, there's a lot to navigate, but it's all navigatable. So yeah, Julius, we'll connect. And because not everybody wants to invest in Hawaii, but for those who do, we'll do a deeper dive. How's that?
That's fantastic.
Okay.
And personally, I'm investing in Cleveland, Ohio, in addition to Canada. So definitely love to hear more about if you have anything to say about the Midwest or the middle of the United States. And there's lots of interesting stuff happening there.
Yeah. Okay. I've got that too. Thank you very much. We'll catch you up.
Thank you very much.
Awesome. Thanks, Julius. I see there's Bhavin. Just raised your hand. I guess this will be the last question. So make it a good one.
So what's your opinion about Airbnb style investing in Hawaii? Is still good or is very saturated?
There's huge opportunity. There's huge opportunity, and there are in the right spot. Like, you have to have the right zoning and the right bylaw. There's a couple of things that are being considered by the city council, but as I mentioned earlier, in terms of the city council it was one big, huge law, proposed law change and amendment. And what they did is they extracted it from kind of like the already zoned locations, because they were just wiping it with a whole blanket. The whole Department of Planning said, okay, all residential locations or residents that are doing Airbnb, all short-term rentals are going to be having these restrictions applied. And then what they did just about a month ago is they said, actually, you know what, that doesn't apply. It's not how it works. If you're in a residential area and you have a vacation home there, there's going to be major restrictions. And I was looking at some amazing properties, and I knew that this was coming. I was like, that's not the way to go. So, but for the locations that are zoned and have the building has the right bylaws, there's still a great opportunity moving forward. And there's other models of ways to do that as well, and collaborating with others. So I've got some ideas. Great questions, everyone. Wow, I could hang out with you guys all night. But I guess I hope that everyone comes and joins our free trial. If you haven't already, please do, and come and check us out at the Community Lab on December 15th. And we're gonna get our hands dirty. Like, this is gonna be, you'll have us at your disposal. The team will be there and we'll be answering your questions. You'll be able to bring your properties, put them in the calculators, and it'll be like a working session and breakouts, and talk to each other and get to know one another, because every single one of you is incredible next level. And even if you're just starting out like Nito, you're next level because you're in these kinds of conversations. So thank you very much, everyone. Mahalo, and stay tuned for more market analysis coming up. See you soon.